On March 27th, President Trump signed the Coronavirus Aid, Relief, and Economic Securities Act, also known as CARES, into law. The intention is to provide relief to homeowners that have a federally backed mortgage who've been impacted by the COVID-19 pandemic in the form of a forbearance. Skipping mortgage payments due to the COVID-19 coronavirus pandemic is a big decision and shouldn't be taken lightly. Adrienne Marks here, coming to you from my Palm Desert home as I stay at home whenever I'm not working directly with my clients. Yes, people are still buying and selling houses during this time, and rest assured we're being very careful and cautious. Here's one of my masks. I made it myself. In today's video, we'll cover things to consider before entering a forbearance program and some of the unintended consequences that can impact you in the coming month. As a reminder, I'm a real estate broker, not a mortgage broker. But the information I'm sharing today is from a loan professional, Brad Zermans, and I'll provide a link to his blog in the description box below. Today, you'll learn what the COVID-19 forbearance plan is, how it works, who's eligible, alternatives to forbearance, and also some answers to the most frequently asked questions. Just to be clear, forbearance is not deferment. It's not loan forgiveness, and it's not a loan modification. Unpaid mortgage payments in a forbearance plan must be paid back when the forbearance period is over. Now let's jump into what the CARES Act plan is. It's a program to provide short-term relief that temporarily suspends the customer's mortgage payments in order to give them time to recover and repay the missed mortgage payments. It includes two key protections for homeowners: forbearance for homeowners with a federally backed mortgage who are experiencing a financial hardship due to the novel coronavirus, and two, a moratorium on foreclosures and evictions for 60 days. Loan servicers have been instructed to provide mortgage relief options, which include ensuring borrowers payment relief by providing forbearance for 90 days if they have a federally backed mortgage, halting of foreclosures and evictions of borrowers living in homes owned by the mortgage servicer until at least May 17, 2020, suspending the reporting to credit bureaus of past due payments of those in a forbearance plan due to the COVID-19 emergency. But it doesn't say anything about not being able to lower your credit score. Offering repayment plans and/or modifications for payment relief to keep mortgage payments the same after the forbearance period if a borrower is eligible and qualifies. All property types are eligible regardless if they're an investment, second home, or owner occupied. Now, some of you might be thinking, what is a federally backed mortgage? A federally backed mortgage is a home loan owned, insured, guaranteed, or backed by FHA, VA, USDA, Fannie Mae, or Freddie Mac. With all of today's stringent regulations that all lenders must comply with in terms of disclosures and 100% transparency, you should know what type of loan you have. If you don't or you've forgotten, no worries. Be sure to check out Brad's blog where he provides links to look up the different loan types. So what if you don't have a federally backed mortgage? Well, you're not alone. About 30% of all mortgage loans are not backed by the federal government. If your loan falls into this category, it simply means your loan does not meet or conform to the federal government or the CFPB's definition of a conforming or qualified mortgage. If you're struggling to make your payment, the best thing you can do is to contact your servicer. That's the company that sends you your monthly bill, and discuss your circumstances and ask them about some options. They're not obligated to offer or comply with the Federal CARES Act, but they might offer you something. Whatever you do, do not stop paying your mortgage without written approval and acceptance of your 90-day forbearance request. If you simply stop making payments without acceptance from your lender, they will report you delinquent and it will destroy your credit score. So what happens when the forbearance plan is over? Remember I said the forbearance program offers temporary relief? When your forbearance plan is over, you might be in for a shock. Why? Because the relief is over and you have to pay all the money you skipped paying at one time. For example, your monthly payment is $2,000 a month and you enter into the CARES forbearance plan on May 1st for a period of 6 months. So on November 1st, you're gonna owe $12,000 plus the November 1st payment, so a total of $14,000 will be due on November 1st. Forbearance plans always have a balloon payment where the borrower is expected to make a one-time lump sum payment when the period is over in order to be reinstated as in good standing. A forbearance is basically just kicking your problem down the road to one day potentially cause even bigger problems for most people. If you didn't have the $2,000, how on earth are you gonna pay $14,000 in a lump sum? That leads to the next question. What if you can't repay the forbearance amount? If you're not able to pay your past due balance at the end of the period, there are 6 possible outcomes. The servicer can begin reporting your late payments to the credit bureaus if you're unable to fulfill the terms of your forbearance agreement. This would destroy your hard-earned credit score. Next, foreclosure. The bank can legally initiate foreclosure if you can't fulfill the terms of your agreement. If you have equity in your home, there's a greater chance this will occur because the banks would much rather foreclose on a home with equity than one that has very little or none. An extended forbearance plan might be an option. You can request the bank approve you for an extension to your initial 90 days forbearance period, which is kicking the can down further, which can lead to an even bigger problem that will need to be addressed. A repayment plan. You can work out a plan to repay the past due amount. Based on your income and expenses, the lender might set up a plan for you to pay an additional $500 to $1,000 a month until your past due balance is repaid. A deferment plan. This is where the lender may add the forbearance amount owed onto the end of the loan. The key here is that you have to get approved for this option. Loan modification. If you jump through multiple hoops and meet certain criteria that your banks require, they may offer you a loan mod. A common loan mod plan would extend the term of your loan out to 40 or 50 years to reduce the monthly payment, or they will reduce the payment for 1 to 4 years, similar to how a negatively amortized adjustable rate mortgage might defer interest and hit you with a much bigger payment down the road. How to qualify for an extended forbearance repayment plan or loan modification. Remember, the first 90 days of forbearance is guaranteed, no questions asked, but you still have to contact your lender's loss mitigation department before skipping mortgage payments. In order to extend that forbearance period or enter into a repayment plan or qualify for a loan mod, it's going to take a lot of effort and persistence on your part. You're going to have to explain, demonstrate, and document the cause for the financial hardship, such as illness, job loss, furlough, income reduction, or other circumstances associated with the coronavirus pandemic. You should know that not all homeowners will be approved for a repayment plan or a loan modification. So you have to be prepared to explain and document. And again, I'm going to refer you to Brad's blog where he lists out the different things you should expect to have to send to your loan servicer and what kind of timelines this is going to involve as well. After all that hard work and effort on your part, if your servicer evaluates your financial situation and doesn't feel your hardship warrants an extension to the initial 90-day forbearance, a reasonable payment plan, or a loan modification, you will immediately have to bring your mortgage current with all past payments, or else they will begin the foreclosure proceedings. Now, many people are wondering, will a forbearance plan destroy my credit score? In theory, no. In reality, yes. The CARES Act gives direction to lenders and servicers to not report late payments when a borrower has entered into a forbearance plan. It says nothing about not reporting the account in forbearance, which will lower your credit score. If lenders can't report a late payment, what will they report? Well, it appears that they're reporting a dash in the place where they would normally report the payment made like 30, 60, or 90 days, or they're simply removing all payment history for the last 12 months. With no more payment history reported for the last 12 months, borrowers lose out on the on-time payment history and credit scores are going to go down. Another thing to be aware of is creditors are reporting an MOP code that indicates the mortgage is in forbearance, and the word forbearance is clearly on the credit report. This is classified as a derogatory mark when it comes to generating a credit score. Will a forbearance plan prevent you from being able to refinance? Yes, it will. You definitely can't refinance while in an active forbearance plan. The only way to get yourself out of forbearance is to pay any unpaid balance. It might also impact your ability to refinance in the future, even after you're no longer in forbearance, because the automated desktop underwriting system that lenders use will read the derogatory forbearance mark. Okay, so who should you contact to set up the loan forbearance plan? You should contact your current mortgage servicer or lender. So you need to look at your statement and there'll be a phone number and a website listed. You can call or go to the website and look for a link for COVID relief information. Some might be wondering, is there an alternative to the forbearance plan? Yes, if you have equity, can verify employment and income, and have decent credit scores, you might want to avoid the forbearance plan altogether and consider refinancing instead. A refinance can help you experience benefits that the short-term plan would provide without damaging your credit. So potentially you can reduce your interest rate and payment every month. It can allow you to take cash out for emergencies or to consolidate high interest credit cards or just pay other bills that are piling up right now during this time. If you want to look into a refi as an option, you can give Brad a call. I don't know him personally, but he did a great job explaining what this program's all about in his blog. And again, check out the link below that will take you right to it. If you'd rather speak to somebody that I personally know about refinancing, just give me a call and I'm happy to connect you with one of my many trusted lenders. I know that this was a lot to take in, but believe me, it's worthwhile to do all your homework and have a good understanding of what type of commitments you're getting yourself into before you sign on the dotted line. Well, that brings today's video to a close. I want to wish you all well and hope that you remain safe during these uncertain times. If I can help you with any questions regarding real estate, feel free to reach out. I'm happy to help however I can. Take good care and remember, wear your masks and wash your hands. See you on the next video.